Hey everyone! If you're a NIO investor, this is a crucial video for you. The recent earnings call revealed several shocking details that every stakeholder should be aware of. I've compiled all the essential insights from the report, so let's dive right in. To begin, let's quickly review NIO's latest earnings results. The company reported a record-breaking quarterly revenue of approximately $2.7 billion, which is undoubtedly impressive. Furthermore, the company managed to stabilize margins at 13.1% in Q4 2024, with gross margins showing an increase to 11.7%. However, there was a significant downside. The net loss amounted to a staggering $974.3 million. While this number might seem concerning, there is a silver lining that we'll discuss shortly. The company also reported cash reserves of $5.7 billion as of the end of 2024, providing some financial cushion moving forward. The earnings call kicked off with the CEO discussing the strategic initiatives for Q2. NIO plans to introduce refreshed versions of its existing vehicle lineup, including the 55, 66, and an entirely new surprise model that will enhance brand positioning and significantly boost margins. The ONVO L90 will also be launched in Q2, with deliveries slated for Q3 and beyond. Additionally, ONVO is expected to introduce a third product in Q4, expanding its portfolio further. The company took the opportunity to highlight some of its technological advancements, particularly in safety and automation. Notably, NIO's industry-leading driver assistance system has reportedly prevented approximately 3.4 million potential accidents. The discussion also touched on the company's ongoing commitment to autonomous driving and the broader NIO ecosystem. It was reaffirmed that NIO remains focused on global expansion, with significant progress being made in improving margins through cost-cutting measures, reduced material costs, and enhanced after-sales services. One of the more contentious topics during the call was the ongoing restructuring within the company. Management emphasized that 2023 was a year of substantial cost-cutting, which played a pivotal role in the margin improvements observed. However, the cost reduction strategy will persist into 2024, with a particular emphasis on supply chain optimization and R&D efficiency. ONVO, in particular, has made significant investments in brand development and retail expansion, which will continue impacting Q1 results. Despite this, the company expects to see the full benefits of cost savings reflected in Q2 financials. This means investors should prepare for weaker Q1 results, with improvements becoming more apparent later in the year. Another major concern raised during the earnings call was ONVO's sales performance, which has not met initial expectations. The management attributed this shortfall to ONVO's relatively low brand recognition. While initial orders following the brand's launch were strong, subsequent orders have faced challenges due to limited consumer awareness. To address this, NIO has ramped up its marketing efforts, increasing visibility through advertisements at train stations, elevators, and social media platforms. Market research indicates that ONVO's brand awareness is only about one-third that of NIO, meaning for every 3 people familiar with NIO, only 1 is aware of ONVO. Additionally, many newly opened ONVO stores are still in the early stages of operation, with sales staff requiring further training to enhance their ability to close deals. However, early indicators are promising. Test drive bookings are increasing on a month-over-month basis, and order volumes are gradually improving. A surprising statistic shared during the call revealed that in 12 regions across China, ONVO's sales have actually surpassed those of NIO, demonstrating the brand's potential. One particularly intriguing question posed during the call was whether NIO and ONVO might eventually merge to reduce costs. While the CEO confirmed that ONVO vehicles would not be sold through NIO's retail network, some operational integration is taking place. In certain areas, a single team manages both brands, and a pilot program is currently testing the idea of allowing ONVO sales representatives to sell NIO vehicles and vice versa. Initial results from this initiative have been positive, suggesting it could become a key strategy for boosting sales efficiency in the future. Looking ahead, the company is focused on clearing inventory in Q1 due to the ongoing transition to newer models. However, this will likely put additional pressure on margins as promotional discounts are applied to facilitate the sell-off. NIO has assembled a specialized cost-cutting team dedicated to identifying new areas for expenditure reduction, which has already resulted in a 10% decrease in the bill of materials costs. The year 2025 is shaping up to be a monumental one for NIO, with the company planning to introduce 9 new vehicle models. These include the highly anticipated ET9 and Firefly, along with a yet-to-be-revealed flagship model expected to significantly boost margins. While some critics have questioned the necessity of maintaining such a broad lineup, management has defended the approach, stating that NIO's multiple models cater to customer personalization preferences. Conversely, ONVO will maintain a more streamlined lineup to ensure operational efficiency. On the financial front, NIO has not ruled out additional funding rounds, but will evaluate financing needs as the year progresses. Management has hinted at significant improvements in cash flow during Q2, driven by the rollout of these new models. However, capital expenditures Capex for 2025 are expected to be higher than those in 2024 due to factory upgrades, new mold development, and the expansion of manufacturing facilities. Notably, Factory Number 3 will become operational this year, further contributing to Capex costs. One positive development is that battery swap station expenses will remain relatively low. This is primarily due to NIO's successful franchising program, which leverages third-party investments to expand battery swap infrastructure rather than relying solely on company funds. This innovative approach allows NIO to scale its battery swap network while minimizing direct expenditures. Another topic addressed during the call was the potential adoption of NVIDIA's storage chips. Management clarified that there are no plans to integrate NVIDIA's chips into NIO vehicles, as the company has developed its own proprietary chip technology. Meanwhile, ONVO will continue to use the NX chip for its vehicles, with no foreseeable changes in that strategy. The earnings call also shed light on NIO's after-sales services, which have been improving steadily. However, power services continue to operate at a loss due to the rapid pace of infrastructure development. On a brighter note, the company's efforts in technology licensing have generated meaningful revenue, although these earnings are not necessarily recurring and may fluctuate from quarter to quarter. In terms of long-term vision, NIO's goal remains ambitious. The company aims to achieve annual sales of 2 million vehicles by 2030, with a targeted profit margin of 20%. The CEO emphasized that reaching this milestone is critical for the company's long-term survival. While the current financial loss is substantial, there are clear signs of progress. Q1 results are expected to be weak due to promotional discounts and restructuring, but Q2 is shaping up to be a turning point. Investors should remain patient and keep an eye on the upcoming product launches and margin improvements in the latter half of the year. This concludes the key takeaways from the earnings call. Stay tuned for more updates as we continue to track NIO's journey toward profitability and long-term growth. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next